Gives me great pleasure to welcome on the Business Today show Professor Aswath Damodaran, joining us from California. Professor, great to have you on the show and have an opportunity to once again catch up with you on all that's happening, and particularly with markets at these consistent records. We know it's backed by the Fed's easy money policy, but nonetheless, it's surprised everyone. Retail investors in particular are wondering, have they missed the boat this time around? What does a retail investor do, Professor, at a time like this?
I'd like to first get rid of this distinction between professional investors and retail investors, because implicit in that distinction is somehow the belief that professional investors know what they're doing. I mean, I've had 40 years of dealing with mutual fund managers and hedge fund managers, and trust me, they're just as ignorant and just as driven by greed as retail investors are. So rather than think in terms of what retail investors need to do, let me talk in terms of what investors collectively need to do.
Okay.
I think one of the first things you need to decide when you come into the market is why you're in the game. Are you in the game to preserve and grow your wealth, which is investing? Are you in this game to make money quickly, to get rich, which is trading? Are you an investor or a trader? And every person coming into the market, professional or retail, has to make that judgment first before they decide what to do next. So in this market, I think this is a trader's market. Investors are going to be shut out, but don't lose faith. Your time will come.
And that leads me to my next question, because you've been a proponent of value investing, and I know over the last couple of years we've also discussed how perhaps the old metrics of value investing have changed, low PE for example and so forth. What does an investor look for today? Do they go for growth? Do they look for other metrics to define what perhaps makes a good investment?
The first thing is we need to realize that when you use a metric, you're using a shortcut, right? When you use PE, price to book, any multiple, using a shortcut and hoping that it gives you undervalued companies. I think increasingly we live in a world where those shortcuts don't work. The alternative is, and you're not going to like what I say, requires that you do the hard work of assessing what value is and where it comes from. And that's a much richer question, because value can come from not just earnings last year or earnings next year, but it can come from growth, it can come from the cash flows you generate as a business. You can be a value investor and buy a young growth company that's money losing. I know that sounds contradictory, but a young money losing company at the right price is a much better investment than an old mature money making company at the wrong price. So I think we need to expand our definition of what value is for value investing to make a comeback.
Okay, so let's talk about some of the big tech listings and IPOs that we're tracking here in India. We all were looking at your comments and monitoring them, and there was quite a bit of debate around it, particularly when Zomato was going in for listing and seeing those prices ahead of that as well during the IPO period. But it's not just Zomato. We're heading into a period where we have Nykaa, Policy Bazaar, Ola, companies with $3 to $4 billion of valuations that are going to be hitting the market, and that too this year. It's going to be pretty busy. Is your skepticism across the board at tech companies altogether? Was it limited to Zomato? How would you view this space?
Yeah, I almost never extrapolate beyond the company I'm valuing, because the danger of extrapolating then you get sloppy. You say, look, I'm not going to buy a tech company because all tech companies are overvalued.
Right.
So I plan to look at tech companies one by one, and I'm always open. I never say never. So when I look at a Zomato, for instance, I'm never going to say, no, I will never invest in Zomato. At the right price, I would obviously invest in any company, which means due diligence requires that when I want to look at a stock, I've got to look at that stock, not make a judgment about a whole group of stocks.
Okay. So
I do think that we're in a period where IPOs are more likely to be overpriced than underpriced. But that doesn't mean that one of them might not make it onto my radar as a fairly valued company or an undervalued company.
Okay. So keep those big IPOs on the radar then. And do you feel for retail investors who have a shot at perhaps being allocated some of those shares, that they should wait in general post a listing so that the euphoria at least has died down a little bit and valuations are a little bit more reasonable? Is that a fair strategy?
No, that's not an unreasonable strategy, because across the world, when companies first go public, The traders rule the game, right? That was true in the US, it's true in India, it's true in China, it's true in every market.
Yeah.
Which means it's mood and momentum that drives day-to-day price changes. I've discovered that mood and momentum can shift in a moment. I remember Facebook went public and I valued Facebook and I said, I think it's overvalued. 3 months later, the stock had halved in value and it's been in and out of my portfolio since.
Okay.
The same thing with Uber. At the time it went public, it looked overvalued to me. 4 months later, it was cheap. So what I would suggest is if you really like a young growth company that's going public, whether it's Paytm or any other company, value the company. You don't have to jump in at the time of the IPO. But keep revaluing the company because one of these days it'll make it back onto your radar as undervalued. Never give up on a company. Think of it as a work in progress where you're valuing the company, the market's pricing the company, and you're hoping to get it at the right price.
You mentioned Paytm. I'm curious to ask you about, whether it's fintech, whether it's Ola in the auto space, Ola with its big EV play. There are, these companies that are now chipping away at the older listed behemoths in the space, whether it be finance, whether it be auto. Do you see that as a trend that's going to continue to grow as some of these tech majors start to contribute more and more to the market cap percentage of GDP?
In some sectors, yes. In fact, there are two things I look for sectors that are likely to be disrupted. One is I look at how big the market is. Financial services, obviously a huge market. Automobiles, a huge market. But the other thing I look at is the existing status quo. I mean, one indicator that a business is going to get disrupted is if nobody's happy. Customers are not happy, companies are not happy, regulators are not happy. And let's face it, that's the state of the game right now in financial services and automobiles. Nobody's happy with the status quo. And when nobody's happy, you're open for disruption. So I think there are sectors where I think disruption is going to come simply because the existing way of doing things is no longer working. It hasn't worked in automobiles for about 30 or 40 years. I'm waiting for airlines to be next on the list because I know airlines have not worked for 50 years across the world. People can't figure out how to run a money-making airline. So you're going to see disruption coming to those businesses where the existing way of doing business is no longer working.
That's really interesting, Professor. And you mentioned airlines, and I've heard you mention this sector before. Is that a huge contrarian play? Because most people are so skeptical about getting into the space right now. Here in India, while there is immense demand that's anticipated, and we have yet another low-cost airline being planned, there are really, however, only 2 or 3 major airlines that are left. I mean, we've got Indigo, we've got SpiceJet that's also working around numbers at a time like this. Jet is, of course, looking at a revival plan. So it's a sector that's really gone through some serious turbulence.
The sector has 2 strikes against it. One is it's very capital intensive. You've got to invest huge amounts of money to enter the business. And it also has a very rigid business model because you have lots of fixed costs. Those fixed costs stay on the books in good times and bad times. In fact, 2020 was a reminder of how handicapped airlines are when they're in a crisis. So I think one of the things that a disruptive airline would have to think about is changing the way this business is structured. I mean, let's face it, the way an airline is run is the way it was run 20 years ago, 30 years ago, 50 years ago. In fact, deregulation in the United States was in 1977. 44 years later, airlines have still not figured out how to change the way they run this business. So I'm not suggesting it's going to be easy, but the time is ripe for somebody to come along saying, the old way is not working. Let's think about a new way to structure an airline, where you don't have the kinds of fixed costs and the rigidity in the business models we've had with the old model. And perhaps this new structure will work. It might take 2 or 3 tries before you get there. But I think the existing way of running an airline has kind of run its course because the end game always seems to be losing money and burning through cash.
All right. Professor, you talked about, the fact that, markets, of course, have been driven by the Fed's policy. And I know you've been you have your thoughts on the Fed, and we'll come to that in a moment. But do you feel that there is any scope for a correction anytime soon, whether it be gradual or a sharp fall? Do you see markets aligning with economic reality, or do you feel we're far past that question, far past the possible bump, and now it's going to be pretty much smooth at the most consolidation?
No, I'm not sure what economic reality is. I'm not a macroeconomist, but the one thing that does trouble me about markets is the mixed signals you're getting from them.
Yeah.
The bond market is signaling slow growth and low inflation. The stock market is signaling fast growth and perhaps high inflation. One of these markets is likely to be wrong. And my guess is the bond market will have to do the correction. Now, whether that correction happens quickly, which would be a big correction, or whether it happens gradually, we don't know. I don't know which is worse. I'd much rather have a 20% or a 15% correction and get it over with than have an extended period of 5, 6, 7 years where stocks do absolutely nothing. I mean, I think that's actually much more damaging for investor morale when you have an entire period where stocks do nothing. But I do think there's going to be a bar mitzvah moment where people wake up and say, well, these things don't match up. But I don't know whether that moment will be overnight or whether it'll be extended over time.
Are you anticipating the Fed to make a change or on rates, change their stance, move to a hawkish stance earlier than anticipated? Do you see that as a possibility?
It might be out of their hands, right? Because if rates start rising, the Fed will have to run to make it look like it made the. I mean, I'm reminded of the story of a rooster called Chanticleer that ruled the farm because every farmyard animal thought that the sun came up when the rooster crowed, and one day Chanticleer slept in and the sun came up anyway. And the other farmyard animals realized that the sun came up whether the rooster crowed or not. The Fed's like Chanticleer. It's got to make it look like the sun's coming up. Rates are going up because they chose to make it go up. So the Fed has any good sense, it's going to get ahead of markets and try to raise rates before they go up. Okay. But my guess is the Fed's going to be chasing the market in this one rather than the other way around.
Okay. Equities have clearly been the asset class of choice, especially, even if we take a look at the Indian market, the rise of retail investors looking to participate and put all their spare savings into equity markets. It's only been a trend that's grown exponentially, over the last year and a half or so. Going forward, do you feel that perhaps it will continue to be the front runner when we aren't seeing any of the other asset classes really catch up? Property, we know, is out of the way right now. Crypto, I've heard you refer to as the millennial gold. I'd love to get your thoughts on that, particularly since it's been very volatile this week.
Among the financial assets, equity is actually running against no competition, right? Because usually when you think about not investing in stocks, you think of investing in bonds, but when yields are close to zero, the question you're asking is, it's equities or nothing. So on a relative basis, stocks are looking really good. But relative to history, they look awful. Right now, stocks in the US are priced at about 6% expected returns on an annual basis in the long term.
Right.
If I'd offered investors 6% in the 1980s or 90s, they'd have laughed me out of the room. When T-bond rates are 1.3%, 6% sounds good. So I think that right now, among the financial asset classes, equities look good. And in a strange way, because returns are so low in financial assets, people are looking to make money elsewhere. So when you look at not just cryptos, but NFTs, people buying these little video clips and paying $750,000, you can see what desperation drives you to do. When you don't think you can make enough money on financial assets, you're going to always turn your attention elsewhere. Until about 30 or 40 years ago, the only choice you had was to buy gold. Yeah. And the reason I call Bitcoin millennial gold is it's become the trading instrument of choice for younger people who think that they can make more money investing in these alternative asset classes than in financial assets, and who can blame them?
All right, so we've got alternative asset classes. On equities, would you suggest indexing? Would you suggest stock picking? What would you say is ideal in a market like this?
For most people, my suggestion is go back to living your lives. You're a doctor, you're an engineer. what the heck are you doing spending 3 hours a day tracking markets? Put your money in an index fund, go back to living your lives. For 95% of people, that's the most sensible strategy to adopt. For the 5% who want to actively invest or trade, my suggestion is find your own investment philosophy. I tell people that the investment philosophy you have to pick should be the one that best fits you. It's not the one that best fits me or the one that best fits Warren Buffett. It's got to be the philosophy that fits you. So if you want to be an active investor or a trader, find the pathway that's right for you. What are your strengths? What are your weaknesses? What are you comfortable doing? And then be true to that philosophy. Invest or trade based on that philosophy. We get into trouble in investing when we try to be somebody else. Look at all the books on Warren Buffett in a bookstore, and how many people buy these books and try to be just like Warren Buffett. Even Warren Buffett is not delivering the returns that you get from these books anymore. So I think we need to find our own pathways as active investors, but let's face it, for most people, active investing is a loser's game. You're not going to walk away a winner from this process. Might as well minimize your losses. Put your money in index funds and go back to living the rest of your lives.
Fair enough. What about commodities, Professor? Would you say leave that out of the list right now?
Well, implicitly, when you invest in equities, you're also investing in commodities, right? Because there's a subset of stocks that are commodity stocks. There are very few commodities that people can invest or trade in directly, at least in a sensible way. So you shouldn't be buying, wheat futures or iron ore futures in your portfolio in the first place. I think commodity prices are still recovering from the China party, because for a decade between 2003 and 2013, the Chinese spending on infrastructure pushed up commodity prices to all-time highs. So if you look at iron ore prices, you look at oil prices, what you're seeing is those prices reverting back to what they were before the Chinese decade. So to take a little adjustment, and I think that adjustment is the pain that you've been seeing for much of the last decade. Commodities have kind of lagged the market. But I think they will find their own steady state now that China is no longer the big impetus driving prices up in every one of these markets.
What is the biggest risk right now, according to you, outside of maybe a third wave or the interest rate hike that everyone's anticipating or speculating on? Maybe that is the biggest risk. What do you feel is going to be something that investors need to keep a watch out for? And how does a retail or a younger investor, I won't say retail, let's say a younger investor, understand how to evaluate risk?
No, the one thing I worry about the most is inflation. And part of it might be my age. I'm old enough to remember when inflation was last a problem. And I remember how much pain it took to break the back of inflation. And I find not just young investors, but central bankers who seem to take this casual view of inflation as something they can control. Inflation is like a genie in the bottle, completely harmless as long as it stays in the bottle. But once it comes out, good luck to you getting it back in the bottle. So my concern would be a return of inflation. I mean, right now we have an excuse. When inflation numbers are high, we say it's COVID. It's, we're recovering from COVID. The economies are opening up. That's why. A year from now, that excuse is going to be done. If inflation is still in the high single digits or double digits, God help us, then it's going to drive everything else in this game. Interest rates are going to go up. Stock prices are going to come down. So to me, inflation is the one number I would keep my eye on to make sure that I think the Fed thinks it's transient, but we're going to find out one way or the other if it is in fact transient or permanent.
Okay. I must ask you on a couple of other millennial fascinations. One is, of course, the tech sector overseas, including the likes of a Tesla. You mentioned Facebook. What's looking attractive, or where's the opportunity, according to you, given some of the fundamental, principles that you've already discussed? Where would those apply?
I remember the proposition I said, at the right price, I will buy any company. At the wrong price, there's no company. I own a bunch of tech companies in my portfolio. I own Facebook, but I bought them after the Cambridge Analytica scandal. I bought Uber in September of 2019 after its stock got pummeled after a couple of bad earnings reports. I own Microsoft, but I've owned it since 2013 when people had given up on the stock. Notice a common theme. all of these tech companies had a downfall at some point in time, and that made them attractive to me as investments. So in fact, if you want to generalize from this, here's my suggestion.
Okay.
There are some great tech companies out there, and right now they might be overpriced. Keep your eye on the price, but keep revaluing them. At some point in time, it's not a question of whether, it's a question of when, there will be a negative surprise.
Okay.
And the same forces that push these stock prices up will push them down, perhaps to a point where they can be bargains for you. So rather than lumping all 10 companies into one group and saying, I will never buy those stocks, or I want to buy all of the stocks, give yourself the adage, at the right price, I would buy any of these stocks, and I'm going to track the ones that I most like.
I know I'm pushing you on this. I know it may be a little ahead of time, but Ola or Paytm, which one would you buy?
Depends on how they get priced. I mean, I would prefer Paytm to Ola because the ride-sharing business is a complete disaster around the world. I mean, ride-sharing is one of those businesses where they figured out how to grow, but nobody seems to have figured out how to make money. And it's not just Ola. It's Didi, it's Grab, it's Uber, it's Lyft. None of these companies have figured out how to make money, partly because there's no stickiness in the model. What I mean by that is I have no loyalty to Uber or Lyft. I'm going to take whichever one is cheaper. And the drivers have the same view. Paytm has some real potential because I think this is a business which is huge. Payment processing is huge and financial services is huge. So if I can get Paytm at the right price, I'd prefer to have Paytm in my portfolio over Ola.
Fabulous, Professor. What a wonderful conversation, and we look forward to speaking with you again, perhaps closer to when those IPOs announce their pricing. Great to have you with us here on India Today.
Thank you. It's a pleasure.